The markets on the whole, and they're pretty sweet today, 17,800 on the Nifty. So let's talk about something else. We have wine on our minds. Sula Vineyards surged over 9% in trade after the company witnessed a 15% jump in their own brand sales in the fourth quarter. This is the quarterly update that the company gave us. And Surabhi joins us back after the break and is standing by with the details on that one. Surabhi.
Sula Vineyards is surging in trade today, and that is because they've released their Q4 sales numbers, and for a seasonally weak quarter, the sales numbers are pretty strong. Their own brand sales has seen a sales growth of 15% in Q4 and a 26% growth on a year-on-year basis for FY23. Their wine tourism business has seen a growth of 18% in Q4 and 30% for FY23. With this, in FY23, they have reported the highest ever annual sales. The own brand sales is a little short of 500 crores, and the wine tourism revenue has clocked in at 45 crores. The growth in revenue is largely driven by premiumization. The elite and the premium brand sales contributed to 52% of their total sales versus 46% in the pre-pandemic times. And the company also expects the wine tourism to be 100 crores for FY24.
All right, so a lot of wine drinking happened in the fourth quarter, and that's reflected in the kind of up move that we saw in Sula Vineyards as well. But that wasn't the only mid-cap in focus. Puravankara also was up over 2% in today's trading session after the company reported strong business updates. In fact, the company reported its highest ever annual and quarterly sales in FY23 and the fourth quarter. We spoke with the management. The CEO, Abhishek Kapoor, said that despite RBI rate hikes, business is as usual. In fact, the RBI rate pause is a positive for the industry. And he also said that they're only constrained by supply and not demand, because demand looks good.
No impact of the rate hikes. In fact, this pause is only a positive, for the sentiment for the home buyers, because now people can comfortably take the decision, and there is an expectation, in fact, that this will continue to hold, which we are also hopeful, and I think it's a very, very positive development. The brand and the market both are supporting. Of course, the brand is we have made a lot of structural changes. But coming back to the point, the demand has been cutting across all businesses, which means Puravankara, Provident, and Purvaland, all three businesses have done very, very well. As a business, we are looking at launching 14 million square foot in next financial year, which is starting April to the next March, right? We already launched 6 million square foot last year. The total value that will get top line potentially, which will be on the floor by the end of next financial year, including the 6 million and the 14 million, which is about 20 million square foot, which will be on the floor, will be almost 15,000 crores over and above the 5,600 crores that you spoke about. So we will be in the market with almost 25,000 crores of inventory.
All right, 25,000 crore worth inventory is what they'll be in the markets with. But another group of stocks that did well were BHEL and Titagarh Wagons, as the consortium of the companies received orders from the Rail Ministry to the tune of almost 80 Vande Bharat train sets worth almost 10,000 crore rupees. The company was declared, remember, the second lowest bidder for 200 train set orders earlier in the last month. And now they've got the orders because they were the second lowest bidder. They got it for 80 train sets. The MD of Titagarh Wagons, Umesh Chaudhary, said that the maintenance revenue will be 1.5 times supply price. So that means that the overall opportunity for the company and the consortium would be close to 25,000 crores.
It is the same tender. It was a tender for 200 trains, and the tender stipulated that the L2 bidder would get 80 trains and the L1 bidder would have gotten 120 trains. So we were the L2 bidders, and we got the 80 trains arising out of that. Our share is about 52% to be precise, we're about 52%, and this is on an overall basis. So yes, it is on the supply and the maintenance part of it. Supply portion is about 120 crore per train, and the maintenance that we will get is about 1.5 times, 1.4 to 1.5 times of the supply price. So each year we would get a maintenance. So this is with a 35-year full maintenance contract. All told, we do understand that at least 1,000 trains of Vande Bharat would really come out on track over the next maybe 5-7 years.
And the other stock on our spotlight today was Venus Pipes. Hit a fresh 52-week high and seen a good up move this month. What exactly explains this up move and what's fueling this rally? Sonal Bhutra joins in with the details on what's making the stock tick.
That's right. Venus Pipes is the stock that I'm tracking today. Hit a 52-week high. This month itself, the stock is high by 12%. And remember, it's a new listing, listed back in May 2022 itself at an 8% premium and a price of 351 rupees a share. And since then, it has seen a massive move from those levels. Now, the news in this stock is that a reputed investor, Ashish Kacholia, has bought 4 lakh shares, and that is at a price of 750 rupees per share. The seller is Nuvama Wealth Finance Limited, that has sold around 1.38 lakh shares. As I said, it is a newly listed company. So let's talk about what could have been the reason why a marquee investor has put in money in this particular company. The company is a manufacturer of stainless steel pipes and tubes. And if we look at the financials in the last couple of years, it has seen a tremendous improvement. So in FY20, revenues were around 170 crore rupees. It has come up to revenues of around 390 crore rupees. Margins from levels of 7% in FY20 are now at levels of 13%. So that's a big jump, almost doubling of margins from lower levels. Profits too have seen a substantial growth. From 4 crores in FY20, now they stand around 32 crore rupees in FY22 itself. Not only a domestic buyer putting in money here, even FPI share has increased from September to December quarter as well. We are yet to get the March quarter numbers. We have not had the conversation with the company in a long time, but the last time we did speak to them, they sounded very bullish. They said the revenue growth for FY24, FY25 should be at a rate of 40%. They see FY24 EBITDA margins higher by 400 basis points. The current market share is 5%. They have a lot of expansion plans, post which market share could go up to 12 to 15%. Going forward, promoters could also increase their stake in the company, and the export contribution will double to 20%. Right now, it's around 10%. So fundamentally looks good, and the management commentary is strong as well. Possibly the reason why the stock is in focus.
7% higher on Venus Pipes on the back of a marquee investor entering the stock. But let's move on to the fifth headline today, and this is all about India Inc. because they're cautious about global growth, but bullish on the Indian domestic market itself. And there were a whole host of industrialists we spoke with, K.M. Birla, T.V. Narendran, Venu Srinivasan and Sanjeev Bajaj. All of them echo the sentiment that the global economy still remains fragile, but India, irrespective, will continue on its growth path. They expect focus on the infrastructure to keep our economy resilient. Let's hear all of them out.
Very clearly, we are in a period of global uncertainty and a fairly extended period, and we still don't see the light at the end of the tunnel. I think in this situation, the significant, I would say, coordination between RBI and the Finance Ministry has put India on a very steady course of stable growth. And we can see that RBI is deftly managing both inflation, which is one of its foremost tasks, but keeping an eye on growth as well. And the rate pause that we saw this time is a welcome signal of that, while keeping in mind that, as RBI has very correctly said, that it will see how things are moving on the ground and decide what to do.
I think, globally, of course, there is some concern because of the fragility of some of the economies. But I think the Indian economy, because of the focus on infrastructure, is looking good. Steel consumption, in my view, should reflect the GDP growth rate. So if we say the GDP is going to grow at 6.5%, 7%, I expect steel consumption to grow at least that. Our growth will be dependent on the capacities that we build. We are in the middle of a 5 million ton expansion, which should be completed during this financial year, but obviously we'll get the benefit of that in the next financial year.
Well, I think we'll continue as a country on our path of growth, which has been very steady in a world of great turmoil and more uncertainty than I've seen in the last 25 years. So I think that's a huge positive for India, and I think as someone from industry, and all of us from industry, I'm sure, feel very proud about it.
Ultimately, we do well when the country does well. All we look to the government is to provide economic growth. And once economic growth comes, I think our industry will do as well as all other industries will.
All right, from the doyens of India Inc., let's talk about the biggest voice that moves the market around the world, the Oracle of Omaha, the man himself, Warren Buffett. He's been speaking exclusively to CNBC, and he believes that the current banking problems are not like 2008. In fact, he also added that some problems seem to have been mismanaged. So Let's hear him out because everyone's listening when Warren Buffett speaks.
So let's talk about what's happening in the banking sector right now. Is this a banking crisis? Is this financials in turmoil? Is this banking crisis 2.0? What would you call what we've been seeing happen?
Well, I would say that some of the dumb things that banks do periodically, have become uncovered during this period, and as one of banker told me one time, he says, I don't know why we keep looking for new ways to lose money when the old ones are working so well. And they made the same mistake, some banks, in this period by they haven't made as many mistakes. They expect to make some mistakes in making loans, but they haven't, and particularly if you're getting into credit card loans, I mean, that's just part of the game. But they haven't made the same sort of mistakes that they made back in 2008 or 9. But they have mismatched assets and liabilities, and bankers have been tempted to do that forever, and every now and then it bites them in a big way. And it's just amazing to me that banks can make presentations to financial analysts and everything, and if one bank bought a bond at 100 and another bought it at 96, and they both held a maturity. One bank carries it at 100 and another bank carries it at 96. I mean, it is accounting procedures have driven some bankers to do some things that may have helped their current earnings a little bit and caused the recurring temptation to get a little bit bigger spread and report a little more in earnings, and it's entered in a result you could predict. You couldn't predict when it would happen, and then once they start looking at one that does it, then they start looking at others, and pretty soon, you know, that everybody is in a position of looking at a number that nobody looked at when it was presented to them a year ago. If you read the 10K or anything of the sort, but the banks did not call attention to what they were doing when it was going on, and I would read investor contact when they would have meetings with financial analysts or the people who follow banking, and nobody even brought up the point virtually. And believe me, if we've got a $50 billion loss or something at Berkshire, we would expect to.
All right, with the Oracle of Omaha making his comments, we'll wrap up on this edition of Markets Today. Thank you for watching. Stay tuned to CNBC TV 18.